David, thanks very much. I'm here at the IMF annual meeting with Gita Gopinath, Chief Economist for the IMF. Gita, you brought it down to 3% world growth. Tell us why you did that.
So there were a few factors. One factor are the rising trade barriers and the continued geopolitical and trade tensions. But then there are a couple of other factors, which is kind of country-specific factors in emerging market and developing economies, and also structural forces, which are low productivity growth, aging demographics, and advanced economies. So these three factors are responsible for this.
How much is trade responsible for what's going on?
If you look at the downward revisions, trade starts playing a bigger role. Now, there's this general slowing that we're seeing in the global economy, but our revisions seem to be driven more by the trade side. Now, our estimate is that all of the US-China tariffs, the ones that were put in place in 2018 and the one that announced, would reduce it by about global growth, the level of global GDP by 0.8% in 2020.
What's a recession when it comes to the world? You don't get much lower than 3 around here, do you?
So once you start going lower than 2.5%, that's usually a scenario where several economies are in recession. So 2.5% tends to be a number that people would associate with a very weak global economy.
You guys were pretty worried. You called it a synchronized global slowdown, and you talked about the possibility of needed coordinated international efforts. Where are we relative to that? Are we close to needing that right now?
We're not there yet, but we do think that things have to be put in play and especially if things get worse. Remember, we are projecting a recovery in 2020 to 3.4%, though we say that is precarious. But it's important that fiscal policy starts playing a bigger role. I think monetary policy simply just cannot be the only game in town.
What does a coordinated international response look like?
It's usually a case I would describe it as a synchronized move, which would be where most major economies in the world, the ones that have fiscal space especially, undertake fiscal stimulus. Now, this happened way back in around 2008-09 when you had the last Great Recession.
Does everybody also cut interest rates further?
So you do want monetary policy and fiscal policy to move in the same direction. Now, many countries already have eased quite significantly, so the space that exists is not that as big, but you certainly want them all moving in the same direction.
Could the U.S. go to negative rates or zero?
Well, we certainly have, technically speaking, there is more space to cut rates. I'm not saying that that's what they should do, but the space exists. We'd have to wait and see whether we get towards a negative territory.
This rebound you talk about, it doesn't come, though, from the advanced economies. It comes from the emerging markets, right? You don't really expect much from Japan, the U.S., or Europe next year.
That's right. I think if you look at Japan, even China, and the U.S., they are going to continue to slow in 2020. So that's not where the recovery comes from. It comes from emerging and developing economies. Half of it comes from recoveries or shallower recessions in stressed economies. This would be Argentina, Iran, Turkey. And about the other half is from a bunch of countries like Brazil and India, where growth was particularly weak in 2019.
India got whacked in your forecast, and you're from India. Is it a personal thing?
I try not to take it personally, but yes, we did have a significant downward revision for India to 6.1%. Now we do expect a recovery back to 7% in 2020.
Let's talk about some of the risks that are out there. You're concerned about financial stability when it comes to lower rates, and also when it comes to greater trade restrictions. Is it possible that the trade itself could put the world into a recession, the trade restrictions and the tariffs?
If this continues and if it escalates further, there are many ways that it can become more severe. Then we're already in a situation where investment is incredibly weak, manufacturing is very weak, and trade is very weak. That could start spilling over to the services sector, which is so far held up. And that's when we would start worrying about going below 2.5% global growth.
So, Gita, 4 world economic outlooks, and you've downgraded each time.
That is correct.
Do you think you might have one coming where you might upgrade eventually?
Well, every time we put this out, we flag the downside risks. And unfortunately, the last 4 times, those downside risks have realized in some form or shape. So we would continue to say that if policy gets it right, then we should see a recovery.
Okay. Gita, stay right there. Folks, Gita's agreed to stay, and we're going to continue this interview online at CNBC.com, but I'm going to throw it back to the anchors at the New York Stock Exchange. Okay, I'm going to take this out, and we're going to continue online. Gita, tell me about the scope for monetary policy, which is already deeply negative. There's some people who argue that negative rates might even be hurting the banking sector and might be hurting the economy.
So monetary policy certainly is running out of space, and especially in some parts of the world. The euro area will be one of those. But whatever we have in terms of the estimates or the implications of negative rates on countries has on net been positive. So it certainly is continuing to support growth. There is the concern with search for yield, financial risks building up, which is why we say it's very important to have macroprudential regulation in place. But on net, even at these low rates, there has been a positive impact for the global economy.
One of the things that keeps happening in the United States is the dollar keeps strengthening. The Fed cuts rates, the dollar gets stronger. The Fed doesn't cut rates, the dollar gets stronger. Is the dollar able to serve a role in helping the world out of a slowdown, or is the centrality of the dollar a negative when it comes to helping relieve pressure on the world?
No, the dollar is kind of captures the weather in terms of the economic sentiment in the global economy. And right now, with a synchronized slowdown, with trade tensions, there's a lot of appetite for holding more dollars, which is why the dollar continues to strengthen, just as the Japanese yen does too, because these are all what's called safe haven currencies. So this is indeed the case. Now, when things are much more tranquil times, then you start seeing the dollar move around much more by differences in interest rates. But we are certainly in an environment also where the U.S. economy is doing better than many other economies in the world, which attracts a lot of dollar strength.
Would you like to see, as the IMF chief economist, another currency or some other basket of currencies be the standard, and would that help the world deal with slowdowns like this?
We could certainly do with some more balance in the world. Now, just if you look historically, there's always been a dominant currency. It used to be the British pound, and now it's the dollar. That's how it's been. But you could have a scenario where it's not so tilted in one direction. That would help in many ways, because I think there's a huge demand for safe assets, and there could be these alternative currency safe assets that are out there. There's much more ability for countries to absorb shocks hitting their economies.
I want to talk, maybe close out with two very important countries that we don't talk enough about in the United States, but this is online, so it's international. India, down by a percentage point. That's a big decline. And that's because you don't really think the fiscal policies there are going to be helpful to economic growth.
There are a bunch of factors for the revision down for India. One of it was the weakness in the non-bank financial corporations and the weakness in credit growth that was tied to it. But there's also been weakness in income growth in the rural areas, and that's an important factor. There's been some regulatory uncertainty and weakness in the auto sector. So there are a bunch of factors. We are actually projecting a recovery back to 7% in 2020, but that's going to be actually benefited from some of the fiscal policies, including the tax cut in corporate taxes. That said, we do flag the concern about fiscal deficits and that these should stay within limits.
Let's close out with China. That is also weakening. Do you expect that to rebound?
So China is slowing, and some of it is needed slowing because this is a structural slowdown. There is, and it's important to have financial regulatory tightening, which is what China is doing. So that factor remains. But the revisions that we've done for China recently were all driven by the tariffs that were announced in 2019, even if they were not implemented. So this particular trade tension does matter for China, at least on the cyclical aspects of its growth.
Gita, do we know enough now from this run up in tariffs globally to say that it's better to have free and global and open trade than to have high tariffs, and that ultimately everybody does better and it's not a zero-sum game? Do we know enough now from the fallout of that?
I think we know enough to say that pretty much all countries lose when there is a global trade war. Now, that said, if you look at individual communities within countries, some of them can be negatively affected by globalization, which is also to be expected. But that's where domestic policy has to play an important role.
Gita, thanks very much for joining us.
Thank you.
Really appreciate it.
Thanks,
Gita
Steve.
Gopinath, live from the IMF World Bank annual meetings.
Thank you so much.
Good.
That's great.
Okay.
All right.